back to AusStock, the program where we look at what's happening in the Australian markets at the moment. I'm your host, Mike Loader, and right now we are looking at inflation and what role banks might be playing within your portfolio. Remembering, whilst Blackmore Capital is the presenting sponsor of today's segment, all of the views and opinions in the following segment are of course our own. We can't take into account everyone's financial needs. We are now joined by Marcus Bogdan, the Chief Investment Officer from Blackmore Capital. Thank you so much for your time, Marcus.
Good afternoon, pleasure to be here.
All right, let's talk inflation in terms of bank shares as well. Now, bank shares are always popular, a topic for investors seeking dividend yield. There's no secret there. How are you currently viewing the banks and the way things are? Do you hold any in the fund as well?
You're absolutely right. So Australian banks are the bedrock to the economy and one of the bedrocks of the Australian share market. So we do hold the banks, Commonwealth Bank, National Australia Bank and Westpac, and they have performed very well over the last year, albeit coming from a very low base affected by COVID. But the government stimulus and the stronger than expected recovery that we're seeing in the economy has led to a good recovery in bank earnings, and as you alluded to, more importantly, the dividends also rising, and now those dividends are at sort of sustainable levels. They've reduced their payout ratios in the last couple of years, and so the banks on average provide 4.5% to 5% fully franked dividends, which still in a very low interest rate environment provide an attractive return.
So the recommendation there is to jump on board if you're not already?
Well, hold at the moment, I think, because we have had a very strong rise in Australian bank shares over the last year. We think that exponential change is now starting to flatten out, and now we'll start to see more moderate growth going here. And there are some challenges for the banks. If we are going into a slower economic environment, a slowing housing market, and the potential there for also business lending to come under pressure. All of those things we've taken account of. We still believe that the bedrock of both their earnings and their dividends, and important their capital position, suggests that having some holding in banks at the moment is still warranted.
Excellent stuff. All right, so given the current outlook and ongoing concerns surrounding the rising level of inflation, how are you positioning the fund, and I guess what companies do you see doing well within this environment based on what we're seeing?
Well, you're right. Inflation has absolutely broadened out, and it's in areas which are potentially problematic. Wages, in residential housing, in construction costs, energy and food. So they're really at the heart of what happens in the economy. And we think that many of those issues will be persistent, particularly around energy scarcity, what we're seeing in food with the war in Ukraine, and then the fact that we're having no migration at the moment is putting a lot of pressure on labour rates as well. So those elements suggest that inflation will be with us for some time, and it will be difficult for the economy to navigate through. So the sorts of companies that we want to hold in that period of time is going back to quality. Those companies that have got resilient earnings, that have got ability to either hold prices or be able to push price increases through either pass-through contracts, which they have with their customer base, and companies with strong balance sheets as well. And that's important because one of the ways that they want to tackle inflation is by raising interest rates, and that will make the cost of debt higher. So companies with strong balance sheets and low debt will not be as affected by it. But inflation is a persistent problem, and I think that we will need to certainly navigate that for the foreseeable future.
Okay, so is it the sort of thing where we need to batten down the hatches in some form or another? Is that the right phrasing?
Well, I think caution and is absolutely a key element there, but I do think that the underlying economy still remains sound. We're still getting economic growth, we're still getting earnings growth, And they're two elements which are incredibly important to the overall health of the share market. But as I said earlier, earnings and the economy will start to moderate, and so we want to be holding those more consumer staples, those more defensive industrial types of companies. And then to counter inflation, we also like commodity and energy companies as well. One is that their prices have held up. They're a great hedge to inflation. And I think one of the great challenges that we're going to have over this next decade is this transition to a low carbon economy when we still need lots of energy and minerals to power the economy going forward.
It's going to be an interesting transition, that's for sure. But Marcus, thank you so much for joining me on the program and unpacking a little more about this space.
Thank you.